let's go ahead and get started. We are delighted to have Ellen McGrattan here, talking about income taxes and entrepreneurship. And Ellen has been visiting here. And when do you leave? So how much longer? Friday. All right. So last chance is to meet with Ellen.
I'm not on the moon.
What? No, but
I actually am reachable anytime.
Right. Anyway, so I think this is probably part of an ongoing project, because we saw a great paper from you last year, and then some previous stuff too on sweat equity and stuff.
Yeah.
So
thank you. As Valerie said, this is we've been involved in a joint project with the people at the Internal Revenue Service. They have a big mission, which is to think about, I use the term entrepreneurship, but to really think about business owners. So I want you to be thinking about, especially during my talk, as I start to model them, I want you to be thinking about US business owners that actively manage a business. They might be a sole proprietor, a partner, or own an S corporation. We call them the pass-through entities. They're of great interest to the Internal Revenue Service because, as many of you know, they're a big part of the tax gap. So part of the project is to think not only about redesign of tax policy, but ultimately about tax administration. So we're inching our way towards that as we do this project. Earlier installments were to get data out that specifically look at this set of people that I'm going to be talking about today. So that was a big part of it. And all of that stuff is up on the website in downloadable form. So for those of you who teach, it's a great resource. And we tried our best to pull out as much as we could. So pulling out the data was a big part of it. And also thinking about, what these business owners do day to day. So that's been a big part of thinking about theory development and how to model them. This latest installment is going to focus particularly on income taxes. What I had presented, what Valerie was alluding to last year, was thinking about both income taxes and capital gains and capital taxes. And that work with Anmal and Paolo Martellini has really, our big conclusion is that the income taxation is much less distortionary than capital taxes. So that will be my focus today. Given Eric is here, he always likes to say, okay, what is the game what game are we playing? I'd like to say, what's the want operator from this installment? What we've been working on in the past year is to really up our game in thinking about methods that can be applied to, how should we tax business owners? So we're going to be, instead of showing up to fight a fire with a squirt gun, we're going to try to use actual hoses. So we're going to bring, better methods to think about transitional dynamics. The model I'm going to write down today, the transition occurs over 450 years, which sounds ridiculous since we live in a country that's only been around 250. So the idea that we're going to do steady state to steady state is absurd. So we want to be thinking about transitional dynamics. And now that we have the data, the other part of the hose to put out this fire is to think about models that actually fit both the macro data and the micro data. Okay, so if you walk, and I should say, just disclaimer, if I walk down the hall in Minnesota and knock on the doors and say, how should we tax business owners? I'm going to get every possible answer. I'm going to get, we should be taxing them, very high rates, to we should be subsidizing them. Now, the people who are thinking about the very, very high rates are thinking about gains from redistribution, and you have these business owners that might inelastically supply effort to build their businesses, and we should tax them. And that's going to bring welfare gains. On the other end, there are people who worry about financial, constraints on these business owners. They worry about misallocation of capital in the hand of these, not in the right hands. And so they're going to get, be more in line with, we should be subsidizing them. Today, I'm going to be really focusing not on financial I know this will disappoint the guys from the finance side, but that those are numbers being punched right now. I'm going to sound like Chris Sims. They're in the computer. Today, I'll be focusing on a model that without them, but there's going to be enough to say to the people who work with IAGARI-like models that are still working with the squirt guns, hopefully. So in answer to him, I want to set a new bar. I want to up the game both in terms of the methods and the data that we're working with. John,
when you knock on the doors of Minnesota, does anybody say we shouldn't be taxing income, we should tax consumption? Have business owners like everybody else?
Not so much. I mean, they talk about consumption on the job, and that's part of the tax compliance stuff.
Is that it? I mean, I know there's even stuff introduced in Congress. Does IRS, are you allowed to ask questions like that? Or is just, we got an income tax, let's go see who pays it?
Yeah, I mean, obviously, when we're dealing with the IRS, they are thinking about income taxes, and that's what they oversee. Really, where this is headed is thinking about both income taxation and enforcement. And it could be we end up with consumption because it's, a losing game.
Get them at the Porsche dealer.
Get them at the Porsche. All right, so let me go on. Now, just a warning, because you guys are such a wonderful crowd and curious about everything. I put little blue buttons all over the place that have, backup pictures. I told Dan, don't unfurl those because it's like putting catnip in front of cats. So I'm going to kind of assert some things that you've already seen in previous talks. Obviously, I'm happy to talk about some of the evidence that's in behind the blue buttons at the end. Okay, so here's where I start to assert some things, and the blue buttons have evidence. As I kind of already alluded, the central characters in what I want to talk about today are these business owners. In the work we've done with the IRS, we have, in the data we've collected, we've learned that the surveys that we usually use to study entrepreneurs do a very poor job in reaching the very people we need, reaching the dollars in entrepreneurship, okay? And if we're thinking about the dollars in entrepreneurship, the reason we're missing them when we look at survey data is because we miss kind of the very right tail and we miss the left tail. We miss, the high earners, but also those people who make losses. We also, I want to point out, because, I'm a macroeconomist, a lot of times I'm talking to macro people and they don't realize that the pass-through businesses that I'll be talking about are actually most of the economy. They're most of business income in the US economy. People think of Jeff Bezos and Amazon, but that's just kind of a small part of our overall business income. Again, I won't unfurl that, but they're more than 50%. And if we really start imputing the misreporting, that it's even bigger. So they're obviously a central group for thinking about income tax debates. So that's the motivation. Now there's a lot of challenge. As I already noted, the IRS cares about them because they report about half of their income, either through underreporting or overexpensing. There's just limited informational requirements of business owners. So
how
no
do we
surprise.
know that half of it's not reported?
We have estimates through audits. And that's going to be part of the project. The next step of the project is going to actually be using the National Research Program audits. So we'll have a better sense of that. Right now, this comes, the reporting of half comes from kind of imputations based on what they do glean from the NRP.
Just define exactly what you mean by business in this context.
Yeah, so every time I say business, I want you to count all the sole proprietors, all the partners, all of the
Do they have to have
S corp
employee
owners.
or you?
No,
Okay, so. the
Most
amount of-
businesses, by the way, just FYI, most businesses do not have employees.
Yes, that's what I'm trying to.
Yeah, employees are kind of a pain. Who wants them? Okay, so, but the one challenge is, of course, that we're seeing
Anyone who
happen.
has non-wage income,
Say it again?
anyone who has non-wage income?
It's not anyone. So
Yes, that's-
I'm gonna put off, talking, when I get to data, I will
Okay.
get more into it. But, you know, when we go and think about owners, I don't want to be including the person who gets $100 for reading the AER report. And so there are thresholds when we do these definitions. It's laid out in the things I'm not unfurling, but happy to talk about it.
But do they have to file in one of those ways rather than as a?
These are going to be people that file either on the Schedule C 1040, they file the 1065, or they file the 1120S. Think about those. Ideally, we would also include smaller, people actively managing C corporations. They're just much harder to see the owners. Okay. Now, something that Valerie mentioned is that one thing that has been of interest to us has been, or kind of been central in our theorizing, is that there's a lot of investments made by these owners in their business that we only see when they sell the business or, put it on the books. So that can make it a little bit difficult because that could be where a lot of the value in these businesses is. Again, I won't unfurl the thing, but in the stuff we're doing with Paolo, we're looking at filings that actually let us see that.
That's what you showed at the CBO conference last summer, right? Didn't you present this,
At the Bob Hall.
the Bob Hall thing?
Yeah.
Thanks.
That's right. Okay, so that kind of makes it a little bit challenging, is that it's harder to see. So hence we're going to be using theory to kind of see these latent things. Okay, so what specifically, here's the game, Eric. We're going to develop a theory with occupational choice and business sweat capital. In some sense, we've already developed that. We're going to be stripping some things out so we can do a better job, I hope, of estimating key elasticities. So we're going to actually be looking at a little bit of a pared down thing relative to other things I've presented to you. But here's the key fire hose. Now we want to match everything up to NIPA, National Income and Product Accounts, and this tax administrative data. Okay, so this is now we're trying to get serious about the data, and we're going to be using some methods we recently have been working with to study the optimal tax rates and the transitional dynamics. So those are kind of the new pieces.
When you think about the optimal tax rates and the elasticities are endogenous to the existing tax code. And it gets back to the question of whether you're just changing the rates or changing the code. One has a smaller, one has a larger potential effect on the elasticity you might expect to observe in that alternative scenario.
Yeah, so these people don't follow the code. So I'm going to be starting them at what they effectively are doing, and then show you transitional dynamics plus welfare gains and information if we were to change it today, so that they're facing something new from now on.
But if they weren't acting consistent with this one, why are we going to assume they're going to act consistent with that one?
I'm imagining that this is the hypothetical. Imagine we could perfectly enforce higher tax rates on them. So it's a counterfactual or lower. Okay, so let me start with the theory. There are going to be two sectors. I want you to be thinking of these pass-through businesses where owners are involved. Because I want to match everything up to national accounts, And there are workers currently, maybe not for long, workers in the federal government, and state government. I'm going to include them with, kind of the other sector. So think of that as all other businesses, including government plus C Corp. And then there are going to be households that are endowed with stochastic abilities to either run a business or to do paid employment. Okay, so here you could think of a dentist, and that'll be on one of my slides, will be either setting up their own practice or working as an employee for another dentist. Yes.
I presume you're going to leave out something Chad Jones pointed to as being big, human capital investment. So you're going to school, if you live in a very high marginal tax rate country, you say, I'll just be a social worker. Whereas if you live in a low marginal tax rate country, you say, let's go get that computer science degree.
Yeah, so we're in the US, for sure. And you are going to, so here, there's going to be, that stochastic ability is going to be, you could think of it as the ability of the person, but it's fixed. Imagine, I want you to imagine that you're kind of coming in as a 25-year-old.
After college.
Yeah. You could imagine doing the whole, let's start the world off, I'm 5, and you make some decisions. There's going to be another.
That's orthogonal to the tax policy.
Yeah, that's going to, yeah.
Well, look, part of the concern is business formation.
But can I hold you up? Can I hold you up? Because there's an investment. No, I can't. It's impossible. It's impossible. There's going to be investment in your business. And so give me 2 seconds. Then there's government revenues on taxes and incomes plus expenditures on goods and services. So I'm coming to the investment, John. So there's a value over the following states of the world. You have financial assets, think bank account. You have CAPA. CAPA for us is going to be think of it as the customer basis, trade names, and other business capital produced from your sweat that's in your business. S is going to be the shocks to productivity and self-paid employment. S could be endogenized and be things that are specific to you, but they're not transferable. Okay, we want to distinguish always things that are transferable from things that aren't transferable, because it's the things that are transferable that we can ultimately see. The things that are inherent to you, they're just inherent to you.
Now, Ellen, how is sweat capital different from human capital? Like, the dentist, the lawyer, these people
really
are highly educated.
It's the patients being passed on. Okay, you have a nice demeanor and a nice smile. That's when you reach. Okay, maybe not. Maybe not. Maybe you'd be a lousy dentist, but those things are not transferable. So we're thinking of, it'll be a letter Z. And in fact, let me pop up the model. So there's going to be the value of being the business owner. Okay, you get utility from consumption. You have disutility from putting effort into the business to build your patient list, and these things. Right now, if you look at the profits, you see the third line, John, pi, it's that there is some exogenous Z affecting your productivity, but that's not the patient list that can ultimately be passed on. One could endogenize Z and add another letter H to, there's human capital that's specific to you that helps, and that can be built while a business owner. Identifying the two will be a little tricky, but that could be endogenous. But let me continue. So we've got utility over consumption, disutility over effort. That disutility over effort is going to be what I'm going to be very interested in. obviously, because I'm going to think about two versions of this model, especially with regards to income taxation. One where you just have a fixed factor of production, cap a bar if you like, and another where you accumulate those. Okay? Most of the profession, just whether if they work with a decreasing returns to scale, you could think of them as having a fixed factor, payments to the owner, who's the residual claimant. But in this case, in our case, there's an elasticity that's critical. Okay, and I'm going to show you that it's critical. Otherwise, we've got, that you get a return, an after-tax return R on your assets. You pay tau B on your tax. That's going to be the income tax of interest today. You get transfers. That's that little TR. You pay some. We're going to add in all the other taxes, John. They're all in there because I got to make everything add up.
You know that question's coming.
Yeah, and it will match the US. It's just what we're going to play with is tau B. And then in the profits, we've got, again, the CAPA, which is the customer base, but they can also scale the business by renting external capital, think physical capital, office space that for the dentist, and maybe you can even rent equipment, and then hiring workers. Your question?
Oh, just
Yes.
quick. This is kind of following up on John's comment, but thinking of it in the broader context of the longer run transition. I don't know the data, but I suspect that it's easier for somebody to become an entrepreneur if one of their parents was an entrepreneur. And so this is a case where if you had low tax rate environment, you could also get more entrepreneurship just from the learning by doing from the parent, going through.
You could think of a parent passing on CAPA to the kid.
Yeah.
Now, in this version, in this model, because we're not thinking about capital taxation and capital gains, we're going to focus on, a dynasty. It's not going to have a life cycle, but you could think of that CAPA being passed down.
It's a really dumb question. What's that last term on the first budget constraint? The 1 minus tau C times C. What is that?
What?
Consumption tax.
Consumption. You have a consumption, not an income tax.
There is income on tau B is an income tax. Then workers will pay an income tax on their problem. I'll show you that in a minute. So those are the income taxes. Then we have, all the usual. We have a profit tax for corporations, etc. And any taxes on things you're holding in your mutual fund, like dividend tax, those kinds of things, would show up, think of R as after all those payments. Okay, so there's a mutual fund.
Okay.
They do all the investing.
They pay my taxes for me and they give
They pay your tax.
Yeah, you answered a question from Lori earlier about observability, or at least I thought so. So here we're assuming there's no problem with the tax authorities observing these profits, right? We're just abstracting from that.
The way it's going to show up is tau B, when I go to calibrate the model, is 20%. Tau B statutorily is much higher.
I see.
It's going to show up as their effective tax when I calibrate. So I'm taking as given that there is
So to
cheating going on.
microfound that in incentives, you have to assume that there's a half probability that you'll get taxed or something like that.
No, I'm just assuming everybody's cheating.
And they're effectively paying half the tax rate. But
Yeah, they're paying up. No, you're right. Now you should ask, well, Ellen, I thought you're going to make it all add up. Want to ask that?
okay, please.
Good question, Earl. Because the NIPA adds that in.
They assume cheating.
Do you know that half of the NIPA is imputed when it comes to business income? A lot of macroeconomists don't know that.
Say it again because it seems ludicrous. They're saying people are cheating. Therefore, we know how much they're cheating. So the number actually is this.
national income and product accountants want to give you a good assessment of what is truly going on. So what they do is they, from the audit data, impute an estimate of the business income. That's what we have, and we are going to use that. We know there's reporting and we know there's imputing, so we know it. And our model is going to be designed to match those things.
There's a certain circularity. We impute it, and you're going to make it add up to the imputed value, which assumes the tax gap is basically based on the.
No, it's a matter of, they don't fill in taxes. There's no tax collected. It's just, there's money. So it's not circular.
I thought you said you're going to make everything match up to.
I'll show you. You hold on to that question. Yes.
The effective tax rate is. Well.
Yeah, the effective tax rate, guys.
Yeah.
This is not the truth.
If only half the people
Now,
pay it.
of course, when we go in our next installment, when we start thinking about enforcement and all those things, we're going to endogenize
That's what I was.
those choices.
Yeah, good.
That's
Question.
where we're headed.
Where I was going.
Yes.
Later on,
Harold,
mentioned
that was the question.
everything's relying on the accuracy.
I,
Yeah.
somebody's name is the Z. And then
Oh,
there are
what's it?
choices,
That's
which
where
like
all
the
debate
business
is
owner
tax
will
rate.
have.
Business owner has
That's where.
everything has an I.
when
A
it
sub
says
I,
FI is
kappa
like
sub
another
I.
Those are choices.
factor of five.
All choices.
So the only exogenous thing that.
Yeah, the only exogenous thing here is
And then in the W.
they take as given the wages and the rents.
Yeah,
They take as
and the
given
wage doesn't depend on like who they hire, because there's heterogeneity there too. I'm just trying to get a sense of where
these are
latent
orcs that they're
Okay.
hiring.
I think, Ellen, the part of the confusion here is that in reality, what you have are two numbers for our income. One is the income you have, and then the one that
Yeah.
you report.
Yeah.
And those are two different numbers, but you're just sort of swapping them together and saying half.
Yeah, I'm gonna say you're
Two different numbers,
agreed.
and that's where the adding in.
We have
Everything
flat
goes on
tax
the
rates, and we have a
accuracy
very
imputation.
progressive tax.
Yeah, no, we don't.
That's my point.
I'll argue that later with you. We'll go out for coffee.
We're in science, but that's-
I'm gonna move on. Oh, sure.
Does it matter if there's cheating? Like people say different.
There will be, and obviously when we go to think about doing that, there is, and I'm sloughing over that. Yeah. Yes. Oh, here was my dentist. So you got to put your time in to build your patient list. You're going to rent your office space and your equipment, and the NB are like your hygienists. So here's the worker problem. So now there's no effort to build kappa, but kappa is a state for you. Because we're going to allow you to switch back and forth. So there's going to be a lambda that determines how much is lost if you switch. Like if you are a dentist working in your own practice, if you now say, oh, such a pain in the butt, now I'm going to go work for this other guy. Well, they're only going to put up with you so long being away, right? Because they'll go to the other guy.
Look, where was the other dentist they hired in the dentist problem? That was part of W? So the dentist and the hygienist are
Yeah.
both part of N?
Yeah. You
So,
could
I'm
say,
just trying
yes,
to,
yes,
I'm
yes.
just worried about this composition
No,
part.
yes. The other dentist would be a worker. Here's the work
Which is
problem where I
different-
have a dentist.
Which is different than the hygiene. I'm just trying to see,
Yeah.
the hygienist and the dentist are gonna have different, I forget your things for skill that was
Yes.
gonna be in the background.
I understand. If you wanted to really to focus on the labor force, you would get into that. These guys are really not central for us. Yeah. But if you wanted to really think about the labor within these businesses, then you could talk about high skilled, low skilled, and things like that. But they're not going to be central in our taxing the business. Because what's going to be central is really the effort the guy puts in or gal puts in to building this. That's going to be central.
Where does the worker's sweat capital? Yeah, does the worker has his own sweat capital, which he's using when he's working or not using when he's working?
It's just decaying.
So he's not putting any. He's not building, when he goes to work with the other dentist list, he doesn't work on it anymore, getting patients.
So,
Those were his old patients in his old
so,
business.
so there's another margin. I'm not quite sure what fits into all this. Maybe you've already explained it and I missed it. So in addition to whether you're going to be an employee in another a big dental practice,
Mhm.
work for Kaiser as a doctor, or you're going to be your own person, etc.
Mhm.
You also have the decision on how much to reinvest in your business
Mhm.
and how much to take out and get taxed. Where does that come in?
Right, so I want you to think of back when we're the doctor, if we're the doctor that's working at Kaiser Permanente, right? And we're now thinking about setting up our own thing. We're gonna be starting basically with no kappa. We had nothing from we can't take it from Kaiser Permanente.
I know this because my daughter-in-law is a dentist and she worked for a while for another dentist, but she always wanted to have her own business.
Yes.
And then, so she bought both the building and the patient list from a retiring dentist and then built that up.
Perfect.
It was a
Yes.
small building. And then
Yes.
she got so successful, she has now bought the much bigger building and the extra patient list
Yes.
from another. And then she even hires another dentist plus hygienist and stuff
Yes.
like that.
So in the model that we had with, that we discussed at the conference for Bob, we had the buying and selling of these businesses. To put it in here, when we look at Taubie, the commodity space blows. So it is actually, it's on a to-do list that we really need to seriously up our game, because that it's very difficult to include all of that.
That's fun. I'm just giving you
detail.
anecdotes.
Oh, yeah, but I mean, yes, but that's exactly right. And when she started, she's going in and then building her thing or buying.
There's no difference between income and capital gain here, for example.
Yeah, so again, these are dynastic, do not have the capital gains or selling in this version of the model. It's another level up. It's another, we need a bigger fire hose.
What's the next? Just go one more.
Okay, sorry.
The worker doesn't exert effort.
Here, we're going to assume that they inelastically supply labor. Okay, they're all working 40 hours a week. The only elasticity in terms of labor is really the effort of the business owner to build the patient list.
Isn't that what he was worrying about? That the marginal tax rate affects effort.
I was worried about investment in skills to become
Okay, but the marginal tax rate affects effort.
So
You're just worried about
one could add those additional margins. We're going to try to understand this model first, because it actually, getting at the elasticity is going to be critical. So I want you to hold on to those great ideas. We purposely left out any kind of margin on the length of your day. It was a purposeful, thoughtful endeavor to leave that out.
But you can go from being a worker to an entrepreneur
Yes.
in the future,
Yes.
knowing that you might want to have some effort put into maintaining your kappa. I mean, if kappa's a broad concept, it's not, it's not just
we don't have
client
that
lists
margin where you can build kappa in your other job. We don't have that.
right. And that's what you want, John.
Okay, so the corporate sector is boring for anybody who's used to Iagari models. This is just like the usual corporate sector, where there's a technology. A is a constant number, and they pass dividends to the mutual fund, and the mutual fund passes a return to the household. Very boring. Here's our mutual fund. I won't go through this. Again, just think there's a bank account and they pass it to the household. Competitive equilibrium, everything, price taking. Here are all the choices that have to be made, all the fiscal variables. Everything has to add up and clear. Usual. I'm going to say something briefly about the computation. I don't want to get too into it, but I want to say, in terms of that model, one thing that was a little bit, like I alluded to at the beginning, the transitional dynamics, because of the sweat capital, are slow. And we've got the two, we've got the financial assets and the sweat capital. So we've got the the two endogenous states. We've got the discrete choice, and we've got these long transition periods of length 450. So to deal with those, we've kind of been working, this is, the first part of upping the game. We've been working on improving certain algorithms for solving these models and for dealing with these transition dynamics. Mainly on methods, perturbation methods, that give us a good guess for using global methods. So we get a very good guess, and then we can kind of get to the answer fast.
I missed something on the general equilibrium concept. So if I'm a dentist and become a worker or vice versa,
yeah,
there's going to be a displacement in the employment market for workers or dentists. Is there a cross-sectional distribution of types of people that are slotting into these positions based on the need for those positions? Or is there just one person that might be a dentist, or he or she might be a worker that doesn't need it?
Are you asking if there's imperfect substitutability between
There's a continuum of agents,
sectors?
right?
There's a continuum of agents?
Yeah.
Is that how
Yeah,
it
so
works?
you're an agent is defined as A kappa Z, which is
Right.
your stochastic ability in self-employment, and epsilon, which is your stochastic ability in pay. That defines you.
And but am I infinitesimal, so I don't need?
Yeah.
And
There's
there's
no feedback in fact.
and
It's a
the-
single
and-
consumption good, I think.
Yes.
yeah, and so, and
What
it's
is it
sort of
about?
IID migration, so there's we're always in steady state population of each type.
We're not always in steady state. So that's what we're going to do, a tax reform, and then
Do a
we've got a
transition.
path of
I see.
interest rates,
That's
we
the
got a
part that
path
I-
of wage rates, we've got the whole general equilibrium, 450 periods.
And is there something that slows down the migration between types once the transition begins? Like, or do we taxes are
I mean,
gonna-
taxes will mean you're going to change the fraction of people who choose to run a business. You'll
is it gonna change
that.
instantaneously, or is it?
I'm gonna show you.
Okay, great. Thank you.
But
And because of the accumulation of this capital, right?
Yes.
It turned out the capital happened when Because-
Well, the only thing that kind of slows you down a little bit would be the other assets, but those don't slow much. It's the kappa that's really the reason
Got it.
we're gonna have a slow transition.
Got it.
That's a big deal. Even if you stop, like kind of quickly putting in effort, this thing has got to decay over time.
Now, Ellen, how do you handle the fact that the state of the distribution state of capital is a continuum? How do you approximate that?
How do I approximate
The state one of the state variables is the distribution of kappas.
yes, so
And
A
you said
and
that's-
kappa, A and
So
kappa
how do you-
are 2D. There's a 2D distribution over them.
Yes.
And then we're going to, for the stochastic shocks, those will be large,
Yeah. So
Markov
your
chain.
state variable is really an infinite dimensional state variable. That at every point in time, you have a distribution over two dimensions. So therefore, that distribution is an element of an infinite dimensional space. How do you approximate that?
yeah, so that'll be approximated, over, we're going to assume a certain size of the A grid or A domain and a certain length of the kappa domain.
Discretize that.
And that is going to be, we're going to have a distribution over think of it as over every point in that domain.
So every point is a continuum.
Agreed, but every point on a grid over those,
Every point in the grid.
Yeah.
I agree.
And so it's a finite, you're discretizing.
there's going to be, think of a grid where there's splines over the grid. And we're going to
So
be,
that's a spline approximation of it's not a discretization of the state. It's a spline approximation.
on the 2D. And then a Markov chain for the
Track
stochastic.
that over time.
Correct. We track that over time.
So, because there's no there are no aggregate shocks here, right?
There's no aggregate shocks.
So that basically the distribution of the capital and the assets are themselves just follow a deterministic path. Basically.
Essentially,
So,
that's
yeah.
right.
So this is just,
And you're finding that you're
Yeah,
finding
yeah.
that path.
But Z and you do have these exogenous processes on Z and that
Absolutely.
are autoregressive.
Well, no,
Okay.
hold on.
In the
Hold on,
paper,
because
in the
I
paper
need-
you did, but now you got something else.
I need something else.
The workers work for another company that pays profits tax. Who do the workers work for?
The workers work either for entrepreneurs or for the corporations/government. And that has to add up.
And so then somebody else pays the profits tax. Okay.
The corporations pay the profits tax. That's right. Okay, so let's get to how am I going to pick some numbers and what the want operator is here. The want operator is I want to match the NIPA and I want to match micro moments that we have from the IRS and some auxiliary moments that we pulled from the Census Survey of Business Owners. And I'll show you where we needed something. Partly because the IRS data was the universe of owners and not owners/business. And I'll show you where that comes in. The first part is very easy. The second part is where work is needed. Okay, what are the key parameters? Say it again?
One thing that I can't quite figure out. So you have somebody who works for a corporation, but it's become very common in recent years for people working in highly skilled people working in those businesses to form teams that get equity in the company. So how is that? That's a way for them to realize their entrepreneurial potential inside.
Are you talking about like
Stock
we're at
options.
Microsoft and they get stock options?
Yeah, for example.
So that'll
How
show up in
about just OpenAI or?
that'll show up in their W-2.
But how are you thinking of those people? I mean, there's
It's
big
in this
entrepreneurial
world.
activity
In
inside
this
those
world,
firms.
since it would be, I mean, they literally are in with workers.
They're-
Yeah,
It's ordinary workers.
They're just ordinary
entrepreneurs in
workers.
a sense.
that's right. Okay, so what are the key parameters here? They're the taxes, obviously, and this I alluded to earlier that the Tau B is going to be about 20%. Whereas workers are paying roughly 37%. The productivity processes we're going to,
Ellen, can I stop? I mean,
Yeah.
So you said progressivity doesn't matter, but some workers, federal, state, and local, some workers pay like 65%, and
I understand.
lots of workers pay 0% or 10%. Who do have a very
Not lots. That's where I'm going to, go to the board later.
Not the what?
Not lots. So-
Most workers are about
People who don't work don't pay anything. So there's
People-
those people.
was a 50%. The people who earn 50 to 80 grand a year don't earn tax rates.
I'm going to hold off on this because I can show you other data. This I don't even have a blue button to do it.
So you think a flat 37%?
I think it's a beautiful approximation. It's like the best
Certainly
one to do.
simplifies.
All right, guys, I'm going to move on.
Get a major result then. I thought, I was like him, I thought that everybody pays it for, you're saying that isn't true?
Don't listen to him.
I know, but I mean,
No, hold on.
what the
I'm
newspaper,
going to cut you guys off or I'll run out of time. Okay. So the productivity process, this is going to be kind of critical or we won't match our IRS data. So the AR1s won't cut it. So I'll show you what we have to do. And then a key thing for elasticities is this sweat capital, the deterioration, like how much do you lose if you switch and the actual, disutility of effort. Those are gonna be things I'm going to show you how it affects.
I hate to say it, but doesn't that mean that 37% of the economy is the government? If what you're saying is true?
46%, federal, state, and local.
Oh, go.
I'm gonna table all these discussions until I can
Okay,
get my
okay.
computer and pop it open and show you guys stuff.
Well, I just, it's a modeling question.
Does this have to do with this slide or?
It's a modeling question when you take to the
yeah.
data.
Yeah.
So what in the model allows things like the labor share or the profit share to change over time? Or is it only taxes? Or is the
double count
the production? I'm just trying to get a sense, like on the transition dynamics, we see huge movements in the NIPA data of profit shares moving and labor shares moving. I just want to know, which is it, the Z, or is it something that's going to be able to move the profit share and labor share?
So this right now is going to be take United States current.
What year?
And I'm
Okay.
going, okay, so we're going to be using data like over the past couple decades, because that's what our IRS data is.
So when I think about that transition dynamics, I don't want to think about transition dynamics in the existing data. I want to think, because there's a huge amount of movement from 2000 to 2020 that were in the labor share or the profit share in NIPA
You
data.
gotta be really careful when you say labor share to me.
I want to say
I'm
whatever,
just gonna say
whatever
that.
Lucas said.
Yeah, yeah.
NIPA's data.
He also
just
has to be careful when he
Okay.
says labor share.
using NIPA data. There was
Yeah.
a moving.
If for exact, yeah, we can go over that.
Okay, that's fine. So you tell me it's not interesting to think about.
No, it's very interesting. It's just, you gotta be careful when you say those words. But what I do want to point to you is thinking about this, estimating this. This is where there's some interesting stuff. So for the business income moments, we start with this AR process, but the innovation epsilon Z is going to be not just a Gaussian. We're going to do, because we want to get some key statistics from the IRS data. We want that the top 10% of our owners have 70% of the business income. We want to get the distribution of income growth. Okay, what that distribution would look like if I unfurled it would be that income changes at the 10th percentile are about minus 50%, and at the 90th percentile are 100%. So these are guys who are going minus 50 plus 100. That spread for the paid employees is about a third to a half of what I've just described. So we want that. We want to get that volatility, and then we want to get the right persistence. So we want to match rank autocorrelations, and we do rank because we're dealing with IRS data where you've got potential problems, in the very tails.
What causes that variation in your model? To get that thing, it's going to be what?
Yeah.
Born capital, sweat capital, or something?
Yeah. So we need to get the right skewness.
Yes.
We're going to model the innovations to that stochastic process to be this, which is kind of, well, actually, I'll do the picture. This, a mixture, so we can get the right tail. If we did the blue, we can't fit our IRS data.
This is the innovation to what do you call that?
Production. It's the innovation.
But it's unexplained. You're not going to be able to say what causes this at all, right? It's not got to do the sweat capital part.
No, the sweat capital is endogenous.
Yeah, yeah.
So the sweat capital you are going to accumulate based on this. Okay? So that the blue will be fine for doing the paid employees. In other words, having a Gaussian, just AR1 process, fine for the paid, but you'll miss the right tail for the other. Okay. So now I'm going to show you some results. I'll first do the macro data, then I'll do the micro data. So let me.
So Z is exogenous productivity for the entrepreneur. So you made a choice to put this unusual distribution there. It could have just as easily been put into the accumulation of sweat capital.
Well, the accumulation of
you do
sweat
some
capital-
advertising and suddenly a whole bunch of people show up and and that's a big jump in your
So
productivity.
think of it that it is affecting, like you're getting shocks. You could lose a client.
Yeah.
Okay, that would show up as, or there's a shock to demand for your stuff, and you could lose some clients. But you're endogenously choosing effort.
What's the E shock? Is that just normal or is that
Exponential.
exponent? So that's the
E is effort.
E's effort. Yeah. Right.
E is endogenous. So that's what you're choosing.
Yeah.
That's your
So-
time into building the business. But you are facing
Yeah. A stochastic process.
You
for
are
productivity.
facing
Yeah.
these.
And is there any way to make that real, what you, like, to have something in the economy that you can relate these shocks to?
Their incomes. So we're going to look to see what incomes come out of our model and match them up to the incomes we see in the data. That's what we're going to do.
So do
Let
you
me
make
start with the
You just look states out of this.
dates out of this.
States of the
State income
Union.
tax, state expenditures,
No, it's all in. Everything's in. This is combined.
but those numbers are way low compared to.
Okay, so let me explain one thing for people who do the national accounts differently than me. I have taken all non-defense for public, so consumption is public and private, including non-defense, because I think of health and education as consumption. The stuff gets tossed in the ocean, that's defense. That's not substitutable with private consumption, so that gets treated separately. Notice transfers here are high because I'm going to assume that, again, your consumption includes the non-defense spending. The other thing I want to point out, which is also in red, we want to match the income to the sweat. Okay? How do we come up with that? We're going to take all of the earnings, including the imputed earnings, i.e. what they say in the audits, and include it with the sweat income. Okay? Like the national accountants, we're going to get the total sweat income, not that reported on the tax.
So Ellen?
Yeah.
If you did that 15, 20 years ago, those numbers would be radically different. That's a decline in labor share.
We'll talk later about labor share. You got it. It's a whole beehive.
Okay, well,
Okay, hold
I don't
that thought.
give me the stuff. I don't want to stir the beehive. You do.
I agree. Okay, so the micro moments, here's where we're matching the top, the profit shares for the top. We actually, given our current parameterization, we're actually overstating a little bit or too much the profit growth. So that we have to kind of adjust some things.
So profit growth is just from the stochastic element of the profit.
Plus the other factors. The sweat profit is,
But mostly,
the most of the why we're going up and down, we will need those shocks, yeah. The business entry and business entry is 2% in the model and the data. Exit rates for us are very useful in identifying our key parameters. The movement in and out of ownership and paid work, self and paid work, and also the shape, i.e. the elasticities of the cost function of the effort. Okay, so we use two sets of data, the SBO, which gives us business age. It's crude because they bin up a lot of things, so it's a little bit crude, but you can see we're a little bit too flat in terms of our exit hazard relative to that data. But if we look at low kappa, I'll proxy young people by low kappa people in the model. We can see that the stuff in the lower panel, which we match up to the owners in our IRS data, kind of fit nicely. So what we need to do is include in the model, so we have to extend the model to include age of the business and age of the owner, which is not in there right now. We have only really the business age. So we're still struggling with how to fit these data, but I want to show you why I want to struggle with it. And it has to do with pinning down kind of the key things that are determining the switching. So how much things deteriorate when you leave the business and go into work, that's going to change just the level of exit. If it's costless for you to go back and forth, never, no cost. So that's going to change the exit rates. Also, the scale and the curvature of our disutility are going to determine, the scale determines, just the entrance, because they do most of the investment. And more importantly, the curvature on this determines the elasticity, okay? And this is going to be critical for the answer we get. I'm going to skip over the numbers because I'm running out of time, and I'm going to give the predictions of the model. We give two sets of results, transitions. What if you kind of move them towards their statutory level? How does it look? And what is the optimal tau B? What are the consumption equivalent welfare gains? And I'll also show you the revenue maximizing, like the Laffer curves, because in practice, most people who study these things, that's all they have. Yeah.
Yeah, just to be clear, I'm not sure I missed this. When the guy moves to from a worker to an entrepreneur,
yeah,
he hires somebody.
He can hire people and he can hire capital.
And that response, and then those people pay taxes, right? And that's in the model, or that's not in the model?
They're all paying, everybody's paying taxes.
But is it the case that when you change the tax rates, the entrepreneur now hires people, but of course he gave up a job? Is that general equilibrium?
Tau W, I'm leaving the worker fixed at 37%. Okay. Okay. And then I'm going to increase from 20% the effective rate on the business.
Okay, I'm asking a much more simple question. There's this intuition that we need on more entrepreneurs because they grow the economy because they have good ideas.
Yes.
That's in here or not?
It is potentially in here because there's going to be welfare gains or losses.
The first of your questions is yes. People, when the tax rate changes, some of those people are going to be workers and pay taxes. That's endogenous in
The
there.
workers have to work for other companies.
The workers are always paying taxes.
Exactly. So when they stop,
everybody pays taxes.
you pay business staff when you're owning, and then if I stop being a business owner and go work for you, I stop paying my business taxes and I pay worker taxes under you. So that's in the model.
Right. That's in the model.
The effect on human, kind of innovation and those kind of things. That's John's question. She's taking the distribution of the epsilons as being fixed.
Right. So that
unless we change the distribution of fees that are, it's just an enforcement question. Basically, by getting rid of businesses, you're enforcing tax.
Think of this experiment as for going from 20% to 40%, as you are enforcing taxes. That's the transition. Yeah. Then the question is, well, what rate would you set if you could?
But Ellen, what about the possibility that the reason we have the taxes set up this way is we kind of know they're not going to pay, but because we have all this benefit, so then we
wait. Well, let me repeat what I said at the beginning. One benefit here is that they're very productive. They will do it anyway, and there is some redistributive.
Okay.
But
that's you made that extreme assumption.
And when I do sweat capital fixed versus variable, it's going to be making it extreme. Okay, because when it's fixed, it's kind of like being back in the Iagari model where there's inelasticity here. When I make it variable, now we start talking about elasticities. we're gonna enforce the taxes. I'm just gonna show you, not the optimum yet, but how does it look? There's just a fixed factor, you don't vary it. And so think Lucas, 1978 almost, versus they can build their businesses. I don't show 450 years because you won't then see the beginning part, which is important. You can see with the fixed, and in fact, I'm going to go to the really critical thing, which is the owners. You see with the fixed, inelastic as hell, you get a little drop in the business owners, a little selection of the better guys stay, but kind of your no impact, variable, very different. Okay. And if I looked at elasticities, which I do, I wouldn't look at the steady state to steady. Is that I've got 5 or you have a question?
I have a question.
Okay, hold on one second. If we were looking at the steady state to steady state, the elasticities we would imagine here are enormous, but the critical ones are along the path. So for example, there was a big change in the TCJA. People have been studying what happened when the effective rate of tax on these very people was changed through the section 199A for the nerds. They get a particular elasticity. We can compare to that elasticity and see kind of like how different is it. And I'm going to show you after I answer these questions. Yes.
If I understand correctly, there's a very strong assumption here, and I'd like to hear your defense of it, which is you can't hire somebody else to produce sweat capital for you.
That's right.
But why? I mean, it's not obvious that that's a sensible assumption, because all the
if they
dynamics
were
here-
building it for you and they're actually, it's their thing, then they're a co-owner.
No, we have theories of organizational capital that you know well, where you
Oh,
hire.
no, but if it's just you're working with it, so, okay. It depends on whether or not you're building it and it's your investment.
I own the firm, I hire Eric, he comes and develops my customer list.
He's
He
envy,
signs an agreement with me that he can't take that customer.
100%. He's envy. He got W. You paid him for exactly what he did. Guys, I get a couple more minutes.
You could take
I
it
don't
with,
know.
the
You couldn't
key
take it
difference
with-
is who owns it.
How to
And I
run
think
business as
Who
a,
gets to have
as a
it
manager.
when you sell the business? Who gets to have it?
Yes, that's the point.
Not him. Okay,
no, but you've
Okay.
got a
Steve
whole
gave him stock
sector over
options.
here that doesn't produce sweat capital, as I understand it.
they
So-
have a different kind of sweat capital. They have a different kind of sweat capital. And
I missed that then when you're laying out the model.
Yeah,
For the C corporations. do they-
C corporations, that KC, I'm assuming is R&D, all the things that are being used in the capital stock of
Okay, well, so
the,
when we're driving people into the C sector by increasing the enforcement of taxes on the, on
Mhm.
what you call the business
Mhm.
owners, where's that positive effect showing up?
But hold on. If I go into R&D in that corporation, I'm not an owner unless I hold stock.
No, but,
Yeah.
but I'm
They're
trying to
making-
Unless I
understand,
hold stock.
I'm trying to understand the efficiency consequences of driving people away from the sector that produces sweat capital to the sector that produces R&D, and I'm missing that. Where is that?
And
Why are they
and
going?
it's likely you would have
They're
given,
getting a higher tax.
I
Yeah.
don't understand why it doesn't show up in these outputs.
and it's likely you would have given Eric equity anyway. And he would have taken a lower wage.
But is it,
And-
I think, Steve, it's an assumption that your business owning productivity and your wage productivity are completely orthogonal. Where the story, I have the same thing in your mind and your head, but there's going to be the selection effect on wages. And I think that assumption is that when I become a worker, now I'm just like a
Yeah,
regular
you're like
guy,
a little
just screwed.
drone. You're
Exactly,
so
like a
why?
drone.
Why?
Exactly. No, I agree.
You can still produce.
That's an assumption I have.
You're a
have.
drone for them.
Yeah, but why can't you be?
You can always do your
There's
own
some
business.
like component that comes through that they could be reallocating some of these skills into
It's not at all obvious that the best place to produce this intangible form of capital, whatever you want to call it, is in these managerial firms rather than the C corporations.
I'm not saying that that's not going on. I did not focus on it here. But I'm going to table this just so I get the last 5 minutes.
Okay.
Because I do want to give kind of the punchlines. So if we do the same calculations as the people who watch section 199A and then look 2 years, what we find, they find elasticities like, percent change in profit relative to the net tax rate, net of tax rate of 0.75. We find 0.62 here. So we're not, obviously if we did steady state to steady state, we would say it's huge, but that's a very long-term thing. What you want to be doing is kind of these shorter term things. And what we can do with the model is also see where is it coming from? And in our model, we can look at time t = 0 and say, okay, on the extensive margin, on the intensive margin, who is generating the changes in those profits? And we find that it's mostly coming from existing firms, either entrants, and they're important on the intensive margin. We're better selecting, and then the extensive margin, the mature firms are exiting. Okay, I'm going to, in my last minutes, I've already given, what are the primary concerns here. We have not added any, financial frictions or anything like that. Really, what the forces right now are really thinking about, kind of in many of the IAGARI-like models, people find very high tax rates because there's a lot of inelastic rich people, and there are big gains from redistribution. We have a fixed sweat case where that force will be most important, and we have the variable case, and the question is where it's elastic, how different do these look? So we can get similar kinds of results, like a tau B of 62% in the fixed sweat case. So this is there's decreasing returns to scale, there's fixed capital stock.
You gotta tell us the objective. Is redistribution part of the objective, or just?
This is maximize a utilitarian welfare function. What rate would you set?
So is redistribution part of the objective or not?
Well,
Yeah, because you're hit by shocks. There's lots of shocks.
Okay, so insurance.
Insurance is the main motive.
You also have incomplete markets.
Yeah, there's incomplete markets.
It must also have a degree of inequality version somewhere.
Now I'm going to do the two together. So this is one of my main ahas. So you see in the fixed sweat case, we've got 62%, close to 1% gains, which is really, in a macro sense, large, as opposed to 33% with 0.27, much lower.
It's like a present value with short-term benefits and long-term costs as people move out.
The calculation is you can either stay status quo with the old tax system.
Below it and in the present value.
Then you're doing the present value.
In the short run.
By the way, I did also, and I'll show you that next, and then I'll stop. We also do, I should say one thing though. If I did steady state, a sequence of steady states, we would have seen the optimum gain, instead of 0.27% in the variable sweat, we would have found a gain of 1.5%. In other words, the steady state is extremely non-reliable and a tax rate of 50%. So it's making a big deal. The final thing is the Laffer curve. Hold on a sec. If we talk to the JCT, they're going to be doing, let's do the revenue maximizing rates, which don't necessarily align with the welfare rates, but that's what they can do. So here, if we look at the change in present value of the, or just the Laffer curve, the number, I believe, it's so flat, I forget even what the number was, maybe 35%, can't even tell. And roughly 76% for the fixed sweat. So again, similar kind of result, although slightly different, higher numbers than what we see in the welfare case. And if we did the business tax revenue, and by the way, a lot of revenue, here's total revenue, a lot of revenue gained from these inelastic guys But if there's any elasticity at all, not much. Okay, so we're trying to contrast the literature, which is really kind of focused on the red line, and the blue, which is allowing for this endogenous sweat. So that's kind of the punchline. And the next step is to bring in the collateral constraints to start thinking about the financing part and how that that force, which is there could be some misallocation of who's running the business. How important is that?
This was all revenue. So the guys who leave the small business to work for C4 are now.
Yeah, that was total revenue, all the revenue.
Now,
Yeah.
these rates don't differ a whole lot from Merle style. Your lower rates don't differ a whole lot.
Well, I've never seen a dynamically fully matched to the IRS data Merle's. Love to see that. Love to see that.
So Ellen, you're holding constant the other taxes, right?
Yes, I was holding constant the other
Yeah,
tax.
so wouldn't you want to do for an optimal tax? Wouldn't you want to do all
What
three?
changes here is the transfers.
Yeah.
That's how the budget added up. Thank you.
All right, thanks so much.